Assalamu alaikum everyone, welcome back to another video. As promised, today's video is all about ETFs. Okay, but before we get to looking at the ETFs that we talked about before, we just want to see why it's important to know the difference between stocks and ETFs, right? So stocks is what we talk about here all the time, so you can buy individual stocks. ETFs include hundreds of different companies in one ETFs, and it tracks maybe loads of different sectors and so on. Okay, if you are a beginner, it might be easier to invest in ETFs because there's a lot to learn, a lot more to understand. So last time when we talked about basically key attributes to look for, it requires a lot more work. So when you start in investing, big investors normally say buy an index fund or buy an ETF, dollar cost average every month, meaning you just add say £100 every single month and forget about it. Okay, whereas picking stocks, you need to know the company, what they do, you need to know financial metrics and all that stuff, you need to read their reports, so there's a lot more work. If you want a hands-off kind of thing, then it's better to maybe invest in ETFs. Okay, and ETFs could be 100 stocks, 200 stocks, 300 stocks, and apparently there's 5 that I've found out. There's a few more I know about and I've talked about in this channel before, but the 5 we're going to talk about is Halal, SPUS, and then 3 iShares, which we've talked about before. So today's video we're going to focus on these 2, and then I'm going to do another video on this as well. So if you're based in the US, then you're going to focus on this. If you're based in the UK, then you're going to focus on this, or even other European countries as well. So they do have this. Now before I do this, there's a company called OIFI. If you've ever used Zoya, they get their information or their standards from this company. The company is called Accounting and Auditing Organization for Islamic Financial Institutions, okay, and is based in Bahrain and is not for profit organization that was established to maintain and promote Sharia standards for Islamic financial institutions, participants, and overall industry. Now to me that sounds good. I came across this a long time ago. I did a little bit reading on their website. There are Sharia board members in this, okay. They're all around the world, so some from Saudi Arabia, some from Sudan, from all sorts of places, from UAE, from Malaysia, for example, Libya, Kuwait, Bahrain, Oman, and so on. So they have loads of different members in this Sharia board. Okay, and what they do is they look at any financial instrument, for example, a mortgage or anything to do with investing in the stock market, and they determine whether that is halal or haram or whatever. I don't know their details. I don't know who they are, where they came from. As long as all I know is just there's a bit of information. And if you click the links, I don't think there's any information there. Maybe Google it, find out a bit more about them, or maybe go into the website and find out. There's loads of different standards here. So you've got in basically the actual standards that was referenced in Zoya and a couple of other things. So the reason I'm showing you this is because Zoya mentions this in their app. Some of the ETFs we're going to talk about have mentioned this as well. These are people that basically hopefully know and understand what is going on. We are beginners. I don't have a financial background in terms of Islamic finance and side of things. I'm hoping they do, and they do the basically to make sure everything we are seeing and investing in is compliant. Okay, and that's it. To me, that means if these people are doing their job, inshallah, to the best of their ability, inshallah, we're not going to go into doing anything that's haram. Okay, that's just my take on this, and just to kind of give you a list to sleep well at night, knowing that there's a board out there. If the companies that you're investing in, or if the app that you're using uses these people, then hopefully then you can sleep well at night knowing that everything is going to be okay, inshallah. So the first thing we're going to look at, first ETF we're going to look at is Halal. This is done by Wahid. Okay, I think they're US based. They are in the UK in terms of you can buy there. They have a little almost index fund thing where you can invest a certain amount every single month. They actually they have in their portfolio, in fact, they have these 3 ETFs in their portfolio. So Wahid has 3 ETFs, Sukuks, which are very similar to bonds and so on, and a couple of other things. I can't remember what it was. Some gold, I think, as the ETF as well in their physical gold. And Yeah, so they have that. And when I came across, first time I actually started investing, I came across this company first, and I started looking at that, and then that's how I came across these ETFs the first time. Okay, so yeah, they are basically based in the US. So the first thing we're going to do is look at this Halal ETF. Okay, so the steps are, first we're going to look at the activity business screening, then financials, and then we're going to look at some of the holdings, and then I'm going to give you my view of what I think about it. So what they're saying is, in terms of investment, the business that they're investing in must not have any of these things. Okay, so in terms of debt, alcohol, firearms, and all of that stuff, tobaccos and gambling, adult entertainment, and all that stuff. Okay, and that's given, that's the normal standard. Then in terms of debt, they're saying the debt of basically has to be less than 33% of the total asset. Okay, remember, it's the total asset, not just the per stock. Okay, so that's basically what they want doing, not total. So sometimes you might see certain companies that are not Sharia compliant in Zoya, but they're looking at total assets, not individual stocks. Okay, cash and interest bearing items are less than 33%. Accounting receivable our cash is less than 50% of the total assets. Total interest and non-compliant activities should not basically exceed 5%. So this is their criteria, and it's clear. Okay, so any of the companies that you're going to see, they're going to combine all of these things together and then make sure the total assets, right, does not have basically a debt that's above 33.333%. Okay, and the same goes for the interest bearing, same goes for the cash, and then so on. So that is really important to understand, because first time when I did this long time ago, that didn't really make any sense to me, but because it's the total asset, that should be fine. Now we're going to look at it now. Before we move on to that section, I wanted to talk about the expense ratio, but I will come back to that in a second. So they have their total, so they have the top basically stocks in this. Apple is the biggest, and it's 17% of this ETF. Then they've got Tesla, Johnson & Johnson, Procter & Gamble, Adobe, Salesforce, ExxonMobil, and Pfizer, Cisco, and Thermo Fisher Scientific, right? This makes up about almost 40% of the overall portfolio. Now, in my opinion, I don't like that. The fact Apple is the biggest holding in this, okay, 17% of Apple. It's better to spread this, okay, just in case. I know Apple's a great company, whatever, but I would have liked J&J to be maybe about 5%, maybe 2-3% of Salesforce, and so on. So again, who am I to make these decisions, okay? So the top 10 constitute about almost 40% of the ETF. Now the cost, so this is what it will cost you. If you invest basically $10,000, it will cost you about a yearly £5. Okay, so you'll pay £5 every year for investing in this ETF. If you basically invest 1,000, obviously the more you invest, the more you're gonna have to pay, because you're paying the expense ratio of 0.50. Okay, and this is quite high. If you're comparing this to the, for example, in index funds or a couple of other ETFs run by Vanguard, whatever, you're talking about 0.02%, whatever, right? But these guys is a little bit more, because obviously they have to make sure these companies comply with all of this and this, and then obviously it takes a lot of time and money to be able to run these things. So obviously that's what you're paying for. So that is this thing. Again, they have another FOB file, okay, which is in here as well. So they've got loads of different files here. Click every single one of them. The top holdings, you could basically, we've seen it already, but you can also see the total holdings in there as well. Quarterly purification of halal dividends as well. Again, that's nice to see. So these ETFs, they really are transparent, and they've got so much information that you can look at. And one of these includes this, okay, and this is kind of a hypothetically speaking. So for example, they say if you invested $10,000 at the beginning of this ETF, so 2019 is when it started, right now you would have had, so you've got three different things here. So you've got the market, you've got the net asset value, and then you've got the return of the index itself, okay? And as you can see, this one is the one that you're after, but they are mirroring each other. Okay, you can't really even see the difference, but you would have had almost $15,000. So you would have made 50% of your overall money. And that's perfect. So you invested 10,000 in 2019, 2020, so about 3 years, whatever later, you would have actually made $5,000. And that's perfect. $5,000 without you doing anything. Okay, you just put in the money in and forget about it. So the total returns, okay, will be for this, okay, will be about 13%, 23%, almost 24%. The market itself had returned 23%, which is almost identical. But the overall index fund, so the overall index, for example, right, not the fund, index itself, has a return of 14.5%. So yeah, so it's more or less tracking the actual index. It's basically beating the market, just below the market. But again, to make $5,000 of 10,000 initial investment, that's perfect in just 3 years. And if you buy this and forget about it, I think that would be absolutely amazing. They've got loads of other information here, so I'm not going to go on to that. So just to finish off, in terms of Halal ETF, you've got a couple of more things here. So you're talking about, so you get dividends, by the way. So you actually, they distributed this dividend. So you get almost 1% dividend. That's absolutely perfect. You can take that, put it back into the investment, and it grows. Obviously, it gives you more money for that. Now, in terms of, they broke it down here. So since basically they started, you would have made, where is the Halal one? Yeah, there you go, 21% or 22%, okay, and so on. So they have a little bit more breakdown there. And then you've got breakdown of where the sectors, for example, so the sector breakdown, if you like. I don't like what they've done here. I would have liked if they had focused on the S&P 500. So you got the energy and all that stuff, but they've kind of broken it down slightly different. But if you look at this, right, so majority of, so you've got technology 34, which is majority here. And then I think was the healthcare 23%. So majority of it comes from technology and healthcare. Now these are great, basically sectors, but why? Because they both are very innovative. They're very growing business. So again, in terms of growth, there's a lot of growth in technology and there's a lot of growth in healthcare, because healthcare has to innovate. So when there's a new virus, they have to come up with whatever, right? The vaccine for it and so on. And technology is exactly the same. So yeah, that to me, that's really good. But again, it's too much on one. So 33%, that's quite high, although my portfolio is almost the same as this, okay? But I love my technology, and I do actually like, I think healthcare and technology are my biggest holdings, so I'm quite happy with this. But ideally, for the long run, you might want a little bit, might diversify. So maybe make this about 20%, or maybe make this 15%, and then spread it around to other sectors. It's got a bit of energy there as well, 5%, okay, which is not bad. So yeah, that's the breakdown on this Halal. So let's now have a look at SPUS. Right, we'll do the same thing again. So in terms of compliant, they've talked about there, that's the company that I was showing you early. Okay, so they've talked about here and said gain value, conscious exposure, or to an ETF composed according to, and then Sharia compliant guidance. So that is basically, maybe then go ahead and read about that and see if you agree with some of the things they talked about. Basically says tracks the performance of around 200 Sharia compliant stocks from S&P 500. And then they talked about basically in terms of debt, it has to be below 30. Remember, Halal said 33%. In here is about 30%. Offers potential outperformance of the broader market. Okay, and then it talks about a couple of the ESGs and so on. So got a bit more information in there. Again, they have a lot of information here, which is quite good. I went through a lot of that, but some of it is really long and boring stuff in there. Now, in terms of their breakdown, so they have a lot of information here, but one thing I want to show you very quickly, and you can download the whole full holdings there, but the top 10 again, Apple, Microsoft, Tesla, Alphabet again, Meta, Nvidia, Johnson & Johnson, Home Depot. This is more growth-oriented ETF. And I think it kind of complements the other one. Although you're getting 12%, if you bought both of them, you're getting 12% of Apple here and 17% on the other one. So you're getting quite a lot, almost 30% of your overall portfolio will be Apple. That's not a bad thing. Okay, But obviously we just need to be careful with Apple. The way they're going right now, they might be non-Sharia compliant very soon. Then you've got Microsoft, and which is a great company. You've got Tesla, which is absolutely brilliant. I would have liked if Tesla was maybe about 5% or more. Okay, Alphabet, again, this is a great company. If you maybe about 10% of that, rather than having some smaller. So like Home Depot. Actually, Home Depot is a great company. I like it. So yeah, that's the top 10. Okay, and like I said, the slight difference between the two of them. So one is looking for 30% below 30% debt, and then the other one is looking for about 33%. So they're slightly different. And like I said, there's a lot of reports in here. But this is one of the things that we're going to look at very quickly, just to show you. Again, they've talked about similar things: alcohol, gambling, blah, blah, blah. They talked about the factor 30%, the debt side of things. So very, very similar in terms of what they're looking for. And it should be, because as a halal instrument, they need to have these things, all right? Expense ratio, just looking for. So again, that's the breakdown of the things. And then the expense ratio, if I can find that, should be here, shouldn't it? Yeah, there we go. The expense ratio is almost the same. Expense ratio, again, the same. So if you invested £1,000, you would pay about $1,000. You would pay about £5 every single year. And then they have a distribution frequency. Every month they pay you a dividend. The dividends, I can't remember what it was, but we'll find out in a second. So they've got 188 different companies within that ETF. And just remember what they said at the beginning. Okay, the halal as well is very similar to this. They're not just looking at Apple itself and saying is it halal or haram. They actually taking all these stocks, right? And then they determining whether out of that 33, do they meet these criteria? So combination of the whole thing, not just one or two. Okay. In terms of returns, as you can see here, in terms of returns, for since it started, is returning about 26%. That's very similar. Very similar to halal as well. Market returns 25, almost 26 there. And then the S&P Sharia industry exclusion-based returns are 26%. That's interesting. That's very good. 26%. So remember, the S&P 500 normally returns on average about 7%. 7 or more percent, right? So you're getting 26% while you're getting dividends. You're just paying about just 0.50 of expense ratio, and you don't have to research about Johnson & Johnson or Procter & Gamble or whatever, so you can sleep well at night knowing that you've actually invested your money in a business or in an ETF that actually is going to give you a good return. I really like this. I wish this was available in the UK. Right, so just my thoughts then to finish this thing off. Okay, so we've now talked about what they're looking for. We talked about some of the holdings. If you want to know more about the holdings, just go here, okay, for this one especially, and just press download full, and then you will see all the holdings together, okay? They haven't said how much of this. You can add up actually that. Anyway, how much this, the top 10 are. But yeah, in terms of overall performance, it looks good in terms of the companies that are in them. They're great companies in my opinion. I would have liked Apple maybe just to be less, okay? Because remember, one of the things I'm worried about is if one of these businesses go down, you're losing about, for example, 13% of the overall portfolio. If Microsoft and Apple, both of them, don't do well in the next 5 years or whatever, then you're losing about almost a 13% of your overall, 23% of overall your portfolio. That's quite a lot. Okay, so just that's something to bear in mind. I don't like the fact that they're investing in companies like Facebook, whatever. But again, remember, they're looking for the overall, not just one or two companies. They look at the overall portfolio, then they to make it, is the overall portfolio Sharia compliant? Yes. And again, there's no companies that sell alcohol or tobaccos or anything like that, the usual stuff. The ones that I'm worried about is the music, cinema kind of thing, especially music for Apple Music and things like that. There's no gambling, there's no weapons, there's no tobaccos or adult entertainment, pork, that kind of thing. So highly leveraged businesses, they're not including in that. Okay, so you are safe. I think, in my opinion, I would definitely put my money into this. And again, if you want to manage your portfolio in such a way that maybe you could have, for example, 10% or 15% of the ETFs, and then the rest of it is stocks. If you love stocks, maybe that's a good thing. So you can have maybe 5 to 10% of ETFs, maybe a bit more, considering what we've just seen now in terms of returns and so on. Okay, I wouldn't mind having maybe 10% of this, 10% of the other one, and then the rest of it have is stocks. Okay, and that's just my opinion. It's not a financial advice. That's what I would have done personally. I hope you enjoyed the video. I'm gonna do the next video as well straight away after this one, so I'm gonna post both of them as quickly as I can. So I'm going to talk about these 3 other ETFs and what they are. We've talked about it before, but we're just going to do a quick update. I hope you enjoyed. If you find any value in this video, please like, subscribe, and let me know if you have any questions. Assalamu alaikum. Take care.